Amid considerable market volatility this week, we've seen policymakers remain in focus. Chair Yellen came before Congress giving her regular testimony to policymakers. So we saw there was, again, a discussion around what impact the much stronger US dollar and also the much weaker than expected commodity prices have had on the US economy and also on financial markets. It is fair to say that both of those factors have moved further than the Fed had expected and is giving them pause for thought in terms of policy. They do overall remain quite constructive on the real economy view, with the unemployment rate now down at 4.9%, employment growth remaining quite robust, and there being sort of signs amongst the consumer and indeed in some other areas of the economy that there is still robust momentum. But they are sort of willing to wait out and hopefully allow confidence, I guess, to heal and to provide stability to markets before they start to think about continuing the normalisation process if we do see that stability come through. At the moment, we don't really expect them to start to think about raising rates until June or possibly a bit later than that. So that would be really the time that's necessary to see markets, I guess, reassess the situation and feel a little more confident about where we are at the moment. It is fair to say, obviously, if that weakness does continue, then they are likely to remain on hold for a further period. The longer this does go on, the more likely there are going to be real economy impacts, and that will have to be assessed with time. Against the view we've seen in the US, where things are looking like they will continue to tighten policy, albeit not for another sort of 3 to 6 months, we have had the Swedish Riksbank overnight cutting its repo rate, which is its benchmark rate, down to minus 0.5%. And this again really highlights another point of tension in this global debate around policy, is that while we are looking for a normalisation to occur in the US, in other parts of the world we continue to see policy being eased and indeed this negative rates being introduced. That's minus 0.5 is quite a significant negative interest rate, and it's really at the forefront of that sort of policy movement. And it really is all about stoking inflation in the Swedish economy to try and get it back to where the Riksbank would like it to be. And that is the case, as we've seen in Japan and also in Europe as well. That's really the reason why they are doing this. That being said, it does create this kind of tension, not only for the differences between policy around the world, but also the potential implications we're seeing for the banking sector in those sectors. So particularly in Europe, there has been a lot of concern in the last week or so about banking profitability, given negative interest rates and very low term rates and the potential impact that has on net interest margins and therefore their overall profitability. It's fair to say this is likely going to be a policy stance that will remain in place for quite a protracted period, and so this instability and question marks over sort of the profitability of that sector is likely to remain in place and have flow-on effects around the world at the moment to areas where there's arguably no real justification for concerns to be. If we shift back to Australia, we had RBA Governor Glenn Stevens come before our Parliament today, and what we saw there was a relatively constructive view over the outlook. They remain quite positive, indeed have been a bit surprised about the strength we've seen in the labour market, and at the same time business conditions are still running a little bit above average, which is constructive not only for expecting further employment gains but also around investment in the non-mining space as well. They are very much happy to remain on hold for the time being. They are conscious of what is going on around the world, but at the moment, given the employment situation as well as the business conditions remaining favourable, they don't necessarily feel that a need to actually act at the moment. We continue to believe they will likely remain on hold through this year, and then as growth starts to firm back to trend and indeed hopefully a little bit above, that will then give them a cause to think about the next move, which we do still continue to believe will be to the upside, but not until the second half of 2017. In terms of sort of the other thing to note this week, we did have the most recent update in terms of consumer sentiment for Australia, and what we saw there was quite a constructive outcome with an improvement in the month, and that takes us back to an overall optimistic or positive level. It is worthwhile noting that it does look like lower oil prices are having quite a significant positive impact on family finances, and that's obviously a key positive there. And also the labour market, although we have seen some deterioration in unemployment expectations, overall it still remains relatively favourable for financial conditions as well. That being said, there is still, I guess, a degree of angst around the housing market. Although we have seen an improvement since December, there is a fair degree of weakness outside the major capital cities, and that's, I guess, consistent with the lack of momentum we have seen in those states, such as Perth and also South Australia. But at the same time, it does give us confidence in the sense that we are still seeing fairly robust outcomes in those key capital cities of Sydney and Melbourne. In terms of next week, policymakers will again be in focus. We have updates on minutes from the last meetings for the RBA and also for the FOMC and indeed the ECB. And in addition to that, we have the labour force data for Australia, which, as I mentioned, is really quite a key data point in recent months and will remain so in coming months as well. We'll see you next week.